Vinit, good to have you with us. Let's talk about the broader markets and really the kind of pickup that you've seen there, whether there are certain segments that you're more clearly focusing on currently in the environment, that we're seeing post-budget with an increased focus also on cyclicals at this point of time.
Yeah, good morning, and thank you for having me on the show. So I think clearly the way things have panned out in the last few months, it has been quite fast and quite swift in terms of the recovery, what we saw in terms of the economy which took place. And I think very important was the budget, where the government has actually made the right noise in terms of their intentions to support the broader economy. And I think in line with that, we are witnessing a lot of optimism as far as the markets are concerned. Clearly, on the back of a very strong third quarter numbers and very strong management commentary, we have seen the valuations across the board have scaled the higher zones. And what we believe, while there are surely in terms of the economic tailwinds, we see that the recovery process is happening. It is much broad-based, which was needed. I think government has provided the requisite support. At the same time, what one needs to be cautious about is the valuations at which we are seeing these sectors scaling new high. We would like to say that the last few months has been quite strong in terms of the returns. And while the economy may still recover, there are headwinds in terms of the cost pressures which are coming up globally. There are talks of inflation and interest rate moving up. So I think there are some worries which may mean that the near-term returns going forward may not be as strong as what we saw in the last few months. But on the whole, we remain positive over the longer term. We like the way things now are more broad-based. There are a lot of domestic cyclical sectors which are likely to perform, given what has got announced in the budget and how the government is sort of supporting the private sector and the India manufacturing focus.
Sure. Fair enough. From the financials in particular as well, Vinit, let me get a sense from you. There has been some attention shifting to the mid-tier NBFCs, increased consolidation. We're now also going to be watching out for some privatization and consolidation as well coming in on the PSU side. But talk to us about whether or not you'd still take that step or whether you'd stick with the frontline private sector names at the moment.
So I think, again, as I mentioned, the intention is quite good as far as the privatization of PSU is concerned. But, we've seen in the past that the privatization exercise has been a Herculean task. The government had come up with the IDBI privatization for a while, and we're still to see that happening. There are many issues, issues linked to the employees union and all that stuff. Even in terms of the efficiency and technology, I think there is still a lot to achieve for these banks. So I would say while the intentions are good, it may be a long haul before we see the privatization taking place. The good step which the government has taken is to sort of clean the books. At least that takes care of the bad book part of the PSU banks, and hence probably that has one potential to accelerate the whole process. But I would say it's still sort of wait and watch. As far as we are concerned, we are more focused on the private banks because we believe that there is enough opportunity still for these banks and private NBFCs to capture market share. As we see recovery taking place in the economy, I think banking, being one of the important backbone to that growth, the growth is likely to pick up there. We were actually positively surprised with the asset quality strength which these banks have shown, and they are adequately placed as far as the liquidity is concerned. So I think it makes sense to be with the private banks, and hopefully if things turn out much better than anticipated on the PSU side is concerned, at some point we will evaluate, but not at the moment.
Sure. Vinit, right now it seems that the rising US bond yield is the big concern, and that's sort of challenging the emerging market rally of late. Would you be a buyer in this current market decline? And do you, more importantly, believe, considering how steep and swift the rally since the budget announcement has been, could we now be headed in for a time-wise correction or consolidation perhaps in the markets?
Initial remark, what we saw in terms of the return in the past few months, I think the next few months may look a bit challenging. Not just the interest rate, I think we have to also face the challenge of rising raw material cost pressures, which is going to have its own impact on the profitability. Also, I think over the next 1 or 2 quarters, it will be clear that what we witnessed in terms of very strong momentum in the third quarter was a mix of pent up as well, and how much of that actually that tailwind goes off, and how much of the growth we are able to retain. I think the clarity will emerge over the next 2 quarters, along with the challenge which we have on the cost pressures and the interest rate, like you mentioned. We believe that the market returns may sort of get more subdued over the next 1 or 2 quarters. While those again, principally, if you ask us, again those sort of remain a good opportunity to keep looking at stock specific or sector specific opportunities at some point in time, because I think the long term structural story has got a bit more visible and clear with all the steps being taken by the government and how the corporates have actually evolved post the pandemic.
Sure. Vinit, where within small caps, aside of the spaces that you already previously talked about, are you still finding valuation comfort?
Right now, after the up move, the valuations across the board have moved up. But in the small cap space, we believe that there are specific segments which sort of are still providing us value. I would say the areas like within the broader theme, I think the agrochemicals and agri inputs is one where things are becoming, the outlook is becoming fundamentally strong. The government has cleared their past dues as far as the subsidy is concerned. Given the last 2 or 3 years of good monsoon and the inflationary food product prices, that bodes well for the farming sector, and we believe that the overall agri inputs as a segment within the small cap looks good. Beyond that, we have the textiles as a category. More importantly, the export-oriented home textile businesses, which are still trading cheap. I think there is a lot of opportunities in terms of the exports market sort of improving demand momentum out there. I would say that amongst the domestic cyclicals, the auto ancillary is one segment where we believe that as the cycle recovers, the auto ancillary sector is up for revival there. And while the valuations have moved up, but we still see that there is potential as far as those are concerned. And lastly, I would like to say that last 1 or 2 months we saw the defensives actually slow down a bit, mostly within the pharmaceutical and healthcare. I think if they continue to underperform, it will mean a good time correction in these segments. I think broadly the small cap healthcare and pharma companies are trading within 18 to 20 times on a decent ROE of 20-odd%. So I think there's a value there which may sort of get unlocked once the euphoria on the cyclical is slows down a bit.
And what's the sense that you're getting when it comes to the entire microfinance sector? You do have growth and collections of a lot of these micro loans that seem to be normalizing. And, the kind of pandemic impact seems to now be behind, with the collection efficiencies expected to pick up quite strongly. What's the outlook on this space, and where is it that, you're finding favor?
Yes, I think barring a few states, the overall outlook for the microfinance is improving as well. And we do have exposure in the small finance bank within our portfolio. And obviously, we believe that in line with the overall improvement which has taken place across the board as far as the economy is concerned, even the microfinance bit is seeing that kind of recovery. We hope that once the normalization take place, these growth rates are also likely to normalize. And I think selectively we do have a good constructive view on the microfinance lenders as well.
Fair enough. And with the overall CAPEX revival theme as well, given that we are seeing the overall operational efficiencies picking up, capacities returning back to normal, the supply chain constraints, all now a matter of the past. How are you looking at the CAPEX revival theme? Are you convinced that we are on our way to seeing a significant improvement here?
So I would say that what we would sort of witness in terms of timelines, as we observe that as the government sort of pushes more capex on the ground, eventually I think over a period of next 6 months or next 10 months, the private sector is also likely to in a way start the capex momentum is what we believe. And if we actually observe the last 4-5 years has been pretty low as far as the private sector capex is concerned, and we believe that as the cycle recovers, as the demand momentum picks up, the capacity utilization, which is still not high, will probably start improving, and that will trigger the private sector capex. And so definitely, given the what the government has actually done in terms of not just being a facilitator, but being playing a supportive role. When we look at the chain of events, be it the tax cut for the corporate sector, be it the PLI announcement, and now the budget having a lot of provisions on spending, privatization, many of the activities will sort of improve. So I think we definitely have a positive view. While implementation is very important, we have lagged in terms of implementation in the past. Hopefully this time, given that we are fiscally challenged, the implementation may be strong and good. And hence, we believe that the overall private sector capex should improve, and that will mean that some of the capital goods and engineering plays, also start doing well over the next 2 or 3 years time period.
In that context, and I noticed that Tata Steel has been on the accumulation list, so commodities as well, do they feature in that overall basket? How bullish are you, even if it is on specific leaders within the basket, but what's the opportunity there?
Yeah, so I think as far as the commodities are concerned, I would say that the factors which are driving the commodity, we all know, is a combination of global plus domestic. When we look at the global factors, I think it is to do with the huge amount of liquidity which is chasing the asset classes, and which has caused some bit of that commodity reflation. While the demand improvement will be a bit of a mixed outlook is what I believe, given that the most countries globally are still facing the challenge of pandemic. And in India also there is some bit of that global optimism which has got sort of built into the price point. These are all global commodities. So I would say that these factors, the visibility of these factors sustaining, remains a bit clouded or very difficult to predict. So I would say, within the domestic cyclicals, if one has to play the good long-term story, I would say cement sector relatively is much preferred. Till the time we have visibility of the liquidity continuing, I think the metal sector outlook may be good, but I think for a long-term investor, one has to, if one has to play the domestic cyclicals, I think cement, capital goods may be the other option to look at, would be our view.
Okay, fantastic. In terms of an overall return expectation as well, an average of sorts, would you be able to put a number on that? Should we expect single digits, double digits, given that the momentum that we've been seeing? What's a reasonable expectation, Vinit?
So, again, I said that, much of the returns probably is what we've seen in the past, and hence the near term may be a bit challenge in terms of the return expectation. Or I would say that investors should come with a low return expectation for a year's time period. And once we see more legs to this recovery, once we see the sustainability of the earnings growth, I think that will provide more support to the return expectation. While the long-term outlook remains good, I would not like to hazard risk as far as what single-digit or double-digit returns one should expect. On a short-term period, the returns remain very volatile. It's very difficult to predict the events. The world has become very volatile. So I would say, more importantly, take a good long-term view. We are in a good shape and form right now. It is just a matter of a timely implementation of various policies which have been announced. And hopefully that drives a broader recovery in the economy, and that should be positive for the equity over a long period of time.
That you stand when it comes to the real estate sector, not just by way of individual stocks, but even diversification in the portfolio into the real estate space, owing to what we've seen due to the pandemic with respect to prices, the overall demand-supply situation. Would you be an advocate of, a decent real estate exposure?
So we've been actually having indirect exposure to the real estate over the last many years through some of the real estate proxies like the building materials and the other indirect beneficiaries of the real estate segment. What we had seen is that they went through, a decent period of underperformance. And now there has been a very smart uptick as far as the real estate is concerned. This is got supported not only by the low interest rates in the economy, but there has been a massive support given out by the states as well. And I believe that the momentum is likely to continue for at least a few more months is what it looks like in talking to people on the ground. There is definitely a demand which has come from a section of people who wants to upgrade to new housing, given the fact that work from home is becoming an important element of the overall process. And so I believe that the visibility for the real estate sector looks pretty okay, at least for the next few months, and beyond which we'll take a call whether it is sustainable. As I see right now, it's more driven by the requirement which select group of people have come up, and also the interest rate which are supportive. So I would say that it's going to be more watch as you go kind of outlook, and right now it looks pretty strong.